and welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Juliette Sarli. Well, US stocks were mixed on Monday as the dollar index hit its highest in more than 2 years and bond yields surged to 14-month highs. The Dow Jones climbed, outperforming the market up 0.7%. The Nasdaq, though, was lower by 0.7% as investors rotated into non-tech shares. The benchmark S&P 500 index flickered near the flat line, ending just in the green, and the Russell 2000 of small caps dipped to its lowest level since September, later reversing some of those declines. Chip stocks mostly lower, Nvidia and Microtech down after the US government said it would further restrict artificial intelligence chip and technology exports. Shares of quantum computing companies continued to slide after Meta CEO Mark Zuckerberg followed the lead of Nvidia CEO Jensen Huang, with comments throwing cold water on the sector. Edison International tumbled more than 11% on reports the Southern California utility has been hit with a lawsuit, blaming the company's equipment for igniting one of the wildfires consuming parts of the state. Shares of Trump media jumped ahead of President-elect Donald Trump's inauguration next week. United Health Group shares rose after President Biden's administration proposed the 2026 reimbursement rates for Medicare Advantage plans run by private insurers, which would result in a 2.2% increase in payments. And Moderna plummeted more than 20% after slashing its 2025 sales forecast by $1 billion. Over in Europe, shares fell to a one-week low as global equities came under pressure following the US jobs data on Friday. The Stoxx 600 index closed down 0.5%. Investors are anxiously awaiting Wednesday's US Consumer Price Index reading, and any upside surprises could further close the door on the Fed easing rates further. US Treasury 10-year yields surged to 14-month highs in choppy trading overnight before pulling back. A strong labour market and persistent inflation causing traders to scale back expectations on the pace of the central bank's cuts. The benchmark 10-year yield rose to 4.799%, the highest since November 2023. The 2-year yield, little changed, at 4.39%. The US dollar rose, driving its peers to multi-year lows, although we are seeing the Aussie recover somewhat in early trade, still under 62 cents. The dollar index, though, surging to its highest in more than 2 years, peaking at 110.17. And the yuan bucked the global trend and rose slightly after China announced more tools to support its weak currency, unveiling plans to park more dollars in Hong Kong to bolster the yuan and to improve capital flows by allowing companies to borrow more overseas. Looking at crypto, Bitcoin just under $95,000 a coin. And a quick look at commodities, oil prices climbing around 2%, hitting a 4-month high on Monday. This on expectations that wider US sanctions on Russian oil would force buyers in India and China to seek other suppliers. Brent rose 1.5% to settle at $81 a barrel. And with the dollar gaining, gold prices dipped. They're now around $26.70 US dollars an ounce. Let's get more on what's moving markets and join Steve Sosnick from Interactive Brokers. Great to see you. Happy New Year. What is happening in the bond market with those yields getting towards 5% on the 10-year, Steve?
Well, good morning and Happy New Year to you, Juliette. Basically, you've just seen, bonds really trending in completely the wrong way. Some of it is fundamental, some of it is just trading, but there are good reasons. I mean, we've really cut back our rate cut expectations. And I say we, meaning global we, not just me. I actually have not been a big fan of rate cuts all along. I think they've been somewhat unnecessary. But the market has cut back its expectations for rate cuts in 2025 from 4 to actually right now less than a certainty of 1. It's about 97% at its peak, somewhere out in November. And so you think about it this way, well, that's 75 basis points off the table. And that, we've risen more than that. We've risen by about, let's say on the 10-year, about, call it 110, 120 basis points from the lows. But that explains a lot of it. The second part about it is, at least particularly in the U.S., we have the inauguration of the new administration next week. And while it seemed like they were originally preaching fiscal responsibility with Elon Musk's Doge and all the other stuff, well, those seem to be falling by the wayside little by little. And we have seen the bond yields accelerate since the budget negotiations of late December. And what happened then was, there was the usual wrangling over the debt ceiling and the debt limit and all that sort of stuff that we have. And the U.S., it's important to remember, is one of the few countries, I think Denmark may be the only other one, that has a debt limit that has to be renegotiated every time we get close to it. And last minute, they had a deal, and so the combination of Elon Musk and Donald Trump threw in this requirement that the debt ceiling be removed. And that threw the negotiations into a tizzy. They broke down, and we ended up coming back to more or less where we were with the debt limit still in place. But that gave away the gave away the game, I should say, for a lot of people, because if you're really preaching fiscal responsibility, the idea of a debt ceiling shouldn't be that much of a problem for you. It is if you want to start, continuing tax cuts and continuing plans that increase the deficit. And that combination, I think, has really spooked investors. And it's not just in the U.S. I mean, the budgetary issues in the UK are problematic. And, to some extent, when the U.S. catches cold, so does the rest of the world. We transmit it. And so if U.S. bonds are problematic, so they are in other countries. And the dollar, of course, being very strong, because if U.S. rates are rising faster than other countries, or we're not cutting rates at the same pace that other countries might, that strengthens the dollar, and that has its own spillback effects.
Absolutely. Now, at the same time, California grappling with these devastating wildfires. It's normally this part of the world that sees fires in our summer. The human cost aside, the inflationary impact here potentially, Steve, because a lot of infrastructure and rebuilding needs to happen.
Yeah, this is something we've started to reckon with today. I had a discussion with our chief economist about it. It's actually on IBKR podcasts if you want to listen to it. And we sort of raised the issue of what might this be. And the bottom line is it's still too early to know. The human cost is terrible. And, I don't have to explain it to many of your viewers because, as you say, Australia's suffered dramatically from these types of events yourselves. But this is not. But when you have the most populous county in the U.S., I forget what it is, about 4 million people or something. But the amount of homes that have been wiped out, the amount of infrastructure that's been wiped out, the amount of cars that have been wiped out, all of this is going to have, at least at some level, some inflationary impact because we need building supplies now. We need infrastructure to support it. We need the labor to build back. And all that has to come from somewhere. One of the things that had been helping inflation numbers had been, some easing of car prices, used car prices and new car prices. Well, there's a lot of people in California who need cars now because, unfortunately, a lot of them were destroyed. And California it's the land of the automobile. And so, all these features are not going to be helpful to the inflation front. It's not going to show up right away. Oh, and by the way, if the new administration is serious about, deportations and immigration restrictions, that's a huge supply of the labor force, particularly for construction work and similar in California. So, while there might be some deflationary impact from the fact that there will be, unfortunately, homeowners who won't be able to rebuild their homes, will probably just walk away from mortgages and things of that nature. And there's, of course, the wealth destruction. In general, I do think this puts the Fed in an even tougher position regarding inflation, unfortunately.
Absolutely, and that all coming in the future, as you say. Meanwhile, we are awaiting the PPI and CPI. When it comes to the overall market and the thematics that we are seeing there, also looking ahead to reporting season, JP Morgan kicking it off, what are we expecting to see and how much, Steve, is it about the forward guidance?
I think it's almost all about the forward guidance, Juliet, because here's why. Market expectations are largely pricing in, call it 15%, depending on who you talk to. But let's say 15% is probably a good consensus for how much earnings are expected to grow in calendar year 2025. Now, what we're going to hear from starting this week is the end of calendar year 2024. So, to some extent, they may, that's obviously not, priced in going forward. But the key will be about the guidance, because we've seen companies get clobbered if they miss their guidance. Think about Micron Technologies not that long ago. And so what we need here is for all the expectations that people have about a good 2025 coming on the heels of two 20+ years in the percent years in the S&P 500 already, that 15% earnings growth is basically the benchmark at this point. And that's a pretty high hurdle if it's already priced in. So the market is going to be unforgiving if guidance is not met. It'll be unforgiving to individual companies if they don't meet their guidance. It'll be very unforgiving to the market as a whole if a big wave of companies don't meet their guidance. I'm not necessarily predicting this, but I think to me, that's the fear you have to watch for. And that's why, it does behoove investors to be thinking about hedging and risk management very carefully as we get into earnings season. Not so much with the banks, because banks are very fluky. No one else is that interest rate dependent. No one else cares about trading revenues, et cetera, et cetera. But I think it will be important to listen to what they have to say about trends in credit quality from their key consumer and corporate customers.
And speaking of trends and consumers, you make an interesting point about looking at stocks of like Walmart and Target, particularly when we're looking at the changing rate picture.
Yeah, Friday was a nasty day, and the way I termed it, and it was probably not the most elegant way to do it, but it was basically that traders showed their true colors and that they really care more about liquidity. Unfortunately, I call them liquidity addicted, which maybe not the best terminology, but basically they're showing that they'd rather get lower rates than a good economy, because on Friday the numbers we got revealed a good labor economy. Now, one of the reasons, justifications, excuses, pick your term there, that the Fed used to justify the rate cuts, the 4 25 basis point rate cuts, two and then two at once and then two individuals, was that the labor economy was slowing down and that the inflation numbers were overall in control. Well, the CPI numbers, the PPI and CPI numbers that are coming out this week, we're expecting 0.3% month over month change on both. That annualizes to over 3%, call it about 3.6, depending on your annualization factor. That's above 2 the last time I checked. And the labor market, instead of slowing, accelerated. And it wasn't just the payrolls numbers being, 90 or 100,000 more than expected. It's also the unemployment rate dipped. So, the justification for cutting rates based on a weakening labor market is not good. Reason Walmart and Target did well is because people were sensible and realized, okay, if people have jobs and more people have more jobs and making good money at those jobs, they can afford to go to Target and Walmart and go buy things. But overall, the reaction that we got in the marketplace was very disappointing, because it tells us it's not about a strong economy. And it's important to keep in mind that at this point last year, we were expecting an economy weak enough to justify 7 to 8 rate cuts of about 25 basis points each. We got half that. And I'll argue probably that's more than we should have gotten. But we got 4 when we were expecting 7 to 8. But why didn't the market act badly? In fact, the market acted great. And that's because the economy was strong. So we ended up throwing rate cuts onto a strong economy. So again, I think we have to be very careful. And it's a strong economy is what allows consumers to spend. It's what allows companies to deliver the earnings per share that market participants are hoping for. So we can't poo-poo that on the face of, maybe we're giving up 25 basis points here and there. And so that's why I think it's going to be very important for the market to decide what it wants. Do we want rate cuts? Do we want a stronger economy? I always vote for the stronger economy. It's not clear how a lot of my peers are voting right now.
All right, Steve, always great to chat to you. Thank you so much. Steve Sosnick there from Interactive Brokers. Let's get one final check on where the local market is set to open in about 2 minutes' time. SPY futures suggesting a solid session despite that choppy night that we saw on Wall Street. That does it for this edition of The Global View. Stick around, the open coming up next.